if you've spent any time at all looking at markets, you've probably seen this, right? That sheer brilliance or doing tons of analysis doesn't automatically mean you're making consistent
Oh,
profits.
absolutely. It's kind of weird, isn't it?
Hmm.
You see incredibly smart people, doctors, lawyers, CEOs, engineers, folks who are top of their game elsewhere.
And they're somehow the market's most consistent losers. It doesn't seem to add up. What gives?
It really is one of the most fascinating paradoxes
Yeah.
in finance, that
Yeah.
intelligence, that analytical skill that works everywhere else. In trading, it often seems to, well, trip people up.
Yeah, and that's exactly what we're digging into today. We're doing a deep dive into this really interesting, sometimes counterintuitive world of trading psychology. We're leaning heavily on the insights from Trading in the Zone.
Great book, really foundational stuff.
Totally. And our mission here is to kind of pull back the curtain on why that raw intelligence often backfires and why, real consistent success. It's less about knowing the market inside out and all about your mindset. Like
Well,
how you're actually thinking while you're placing trades, managing positions. We really want to show you why mindset is, well, the ultimate game changer.
so many traders start from this basic misunderstanding. They think if they're struggling, if the results aren't consistent, the answer must be more analysis or, better analysis.
Right. Find that magic indicator or system.
Exactly. And it sends them down this rabbit hole, this endless quest for more market knowledge. They're convinced if I just gather enough data, I can predict what's next.
It feels so logical, though, doesn't it? Just study harder. If you want to get good at chess, you study openings and games. You immerse yourself. Seems like the natural path.
It does seem logical on the surface.
But if the book argues this is basically a trap, what's the fundamental flaw there? Why doesn't just knowing more work?
Well, the book is pretty clear on this.
Yeah.
Intelligence and good analysis, yeah, they help, they contribute,
Yeah.
but they are not the defining factors for consistency. The author, having worked with, the best and the worst traders, he points out that the biggest group of consistent losers, it's precisely those highly accomplished, super smart people.
Wow.
He just flat out states, the best traders simply think differently.
Thinking differently. Okay,
Yeah.
that sounds simple, but maybe it's deceptively simple. What does that actually mean tangibly? Is it like literally seeing the charts differently? Or is it about our internal reaction to the charts?
It's more the latter, I think, because, yeah, the market offers endless opportunities, right?
Yeah.
It's always moving, always generating information.
Right.
But it also throws some of the most sustained, difficult psychological conditions at you constantly.
Right.
So just learning to spot a setup, that's one thing. Learning to think like a trader while you're acting on that setup, that's a whole different ballgame.
Right. You need the mental framework to actually execute properly under pressure.
Exactly. And what's really wild is how many things that work perfectly well in daily life, attitudes, principles, ways of thinking, actually have the opposite effect in trading. Well, the book calls trading chock full of paradoxes. Things that seem like common sense just don't apply, or they backfire.
Okay, so the market isn't the bad guy here, and our own brains are kind of the issue. How do we even start to untangle that? The book mentions these mind-bending paradoxes. Let's start with the big one. Risk.
Ah, yes, risk.
Trading is risky inherently. I mean, no trade is guaranteed, right? The chance of being wrong, losing money, it's always there.
Always. But here's the paradox. The typical trader spends a huge amount of mental energy trying to avoid accepting that reality.
How so?
Well, think about predefining your risk. Deciding before you enter the trade, if the market does X, I'm out, I take the loss. That act forces you to confront the possibility of losing right then and there.
Yeah, makes sense.
And most people, they resist that. They don't want to face it, often because they've already kind of convinced themselves they know what's going to happen next. They're focused only on being right.
And I guess that feeds right into what the author calls the black hole of analysis.
Exactly. If your underlying belief is more analysis equals consistency, you just keep digging. More indicators, more news, more variables, looking for that perfect signal that guarantees a win.
Which it doesn't exist.
Right. And then you still feel that sting when some random event, something you didn't account for, causes a loss anyway. And you're disappointed, maybe even angry.
So if it's not the market's fault, where does the problem really lie?
This is critical. The book argues the problem isn't the market. The market's neutral. It just moves, generates information. Prices go up, prices go down. It doesn't have power over how you feel or perceive things.
Okay.
The problem, the book says, is that you can't trust yourself. Your own fears, the pain you associate with trading that's generated internally, it comes from, quote, faulty trading attitudes and perspectives.
Wow. Okay, so the real battlefield is inside our heads, not on the screen. And these faulty attitudes, they lead directly to mistakes, right? The book mentions something striking about the source of errors.
Yeah, it's a huge claim, but powerful. It says something like 95% of trading errors, the kind that make money, just vanish. They stem from four primary trading fears.
95%. What are the four fears?
Okay, they are the fear of being wrong, the fear of losing money, the fear of missing out, FOMO, and the fear of leaving money on the table.
Man, when you list them like that, it's so relatable. Being wrong, losing, missing out, not getting enough.
Right. And think about what fear does. It's paralyzing.
Yeah.
It physically narrows your focus. You literally don't perceive other possibilities or conflicting market information when you're scared.
So you might miss an exit signal or ignore evidence against your trade.
Exactly. You won't see the rational options until that fear starts to subside.
Yeah.
It feels like the market is causing you pain, but really it's your internal state, your perception filter, that's creating the discomfort.
When you list those fears, being wrong, losing money, missing out, leaving money on the table, I mean, I think anyone who's even thought about trading has felt at least one, probably all of them, at some point. It feels almost hardwired.
It really does.
So how does the book suggest we even spot when these fears are taking over in the heat of the moment? It's one thing to know them intellectually.
Yeah, it's tough in real time. The book points out our minds are basically wired to avoid emotional pain. So this avoidance shows up in a couple of ways.
Okay.
One is conscious rationalization. You start doing things you wouldn't normally do, calling trading buddies, hoping they'll agree with you.
Oh, yeah, looking for confirmation bias.
Totally. Or suddenly adding indicators you never use, just hoping one will tell you you're right. Or it can be subconscious. Your mind literally distorts or just excludes market information that feels threatening or painful.
So you filter reality.
Kind of. It creates this illusion, as the book calls it, that stops you being objective. You might zoom in on the tiny price ticks going your way while completely ignoring the bigger picture trend moving against you until, bam, the loss is suddenly huge and undeniable.
Okay, so that's the problem laid bare. Faulty perspectives, fear-driving errors, distorting reality. What's the path forward then? How do we get to consistent success? The book says something interesting about winning trades.
Right, it makes this crucial point. Putting on one winning trade,
Yeah.
or even a few in a row,
Yeah.
that takes absolutely no skill.
No skill. Really?
Well, think about like guessing a coin toss. You call heads, it comes up heads. Did that take skill? No, it's random chance over the short term.
Yeah.
Anyone can get lucky once or twice.
Okay, I see the analogy.
So isolated wins aren't the goal. What does require skill and what actually defines success is consistency. And the book describes this consistency not as a set of actions, but as a state of mind.
A state of mind.
Yeah, something that once you achieve it just becomes a natural expression of who you are as a trader. The ideal state is described as carefree.
Carefree. That sounds maybe too relaxed for trading.
It doesn't mean careless. It means objective, confident, but crucially not euphoric or fearful, just neutral and accepting. And this state allows traders to enter what the author famously calls the zone.
Ah, the zone. People talk about that in sports all the time.
Exactly. It's that mental space where your mind and the market seem to be in sync. You're not forcing it, you're just flowing with it.
What I found really fascinating was this description of the zone. It sounded almost mystical, like a flock of birds moving together, sensing what the market's about to do. Like there's no separation between you and the collective market mind. Can you expand on what that actually feels like according to the book?
Well, the sense is it's less about mystical connection and more about effortless execution and perception. It's not about trying to make something happen, but being in a state where your intuition, honed by experience in your system, aligns perfectly with your logical analysis. There's no internal conflict.
So no fear, no second guessing.
Right, just observation and action based on your edge. And this leads to a really powerful insight the book offers. If you feel like you're struggling, like you're fighting the market
Which many traders do.
constantly, but you're actually struggling against your own internal resistance, your fears, your rigid expectations. The market isn't fighting you, it's just presenting information. Your internal stuff is creating the fight.
Okay, that's a huge shift in perspective. Stop fighting the market means stop fighting yourself. So how do we cultivate that carefree state? How do we get into the zone where consistency feels natural?
The book argues it starts with belief. Just specifically, internalizing 5 fundamental truths about the nature of trading. These form the core of a probabilistic mindset. To get consistent, your mental environment has to align with these truths.
All right, let's break them down. What's the first one?
First truth is, anything can happen. And this is profound. It means truly accepting that there are always unknown forces at play. Millions of other traders with their own reasons, their own systems. Any single one of them, maybe some huge fund somewhere, could make a move that completely negates your edge on this particular trade. Accepting this deeply stops you from seeing unexpected market moves as threatening or personal attacks.
Intellectually, okay, anything can happen. But truly internalizing that, especially when your money's on the line, that sounds incredibly hard for our prediction-loving brains.
It is. It's probably one of the biggest hurdles.
Yeah.
But it's essential. And accepting that uncertainty is key to the second truth.
Which is?
You don't need to know what's going to happen next to make money.
Okay, that seems counterintuitive again. Don't I need to predict the direction to profit?
Not in the way most people think. Trading isn't about predicting the outcome of any single event. It's a probability game, a numbers game, like a casino.
How so?
Does a casino know if the next spin of the roulette wheel will be red or black? No. Do they care? Not really.
Yeah.
They know that over thousands of spins, the small edge they have, the green zeros, will guarantee they profit. So you commit to taking every trade that fits your defined edge, understanding that wins and losses will be essentially randomly distributed over a large enough sample size. You play the probabilities, not the single outcome.
Right, the casino plays every hand of blackjack dealt. They don't try to guess which one will be a winner. And this idea of probability, it leads directly to the third fundamental truth, doesn't it?
Exactly. Truth number 3. There is a random distribution between wins and losses for any given set of variables that define an edge.
That sounds really important for handling losses.
It's huge. If you truly deeply believe this, what does a losing trade mean? It doesn't mean your edge is broken or you did something wrong, assuming you followed your plan. It just means, well, that was one of the expected losses in the random distribution. And therefore, every loss statistically just brings you closer to the next win within that distribution. It strips away the negative emotional charge of losing. It's just part of the process, like the casino paying out on the winning bet. It's expected.
Wow, okay. That reframes losing completely. What's the fourth truth?
The fourth truth clarifies what an edge actually is. It states, an edge is nothing more than an indication of a higher probability of one thing happening over another.
So it's not a guarantee, just better odds.
Precisely. It's your statistical advantage, however small, identified through testing or observation. Your job, then, isn't to predict the outcome of this specific trade. Your job is simply to see if the variables defining your edge are present right now.
And if they are?
And if they are, you act. You take the trade. You don't need to gather other evidence or wait for perfect confirmation. In fact, the book argues that overanalyzing beyond your defined edge actually introduces randomness and hurts your results.
Why? Because it shows you don't fully trust the edge itself.
Exactly. You're second-guessing the probabilities you supposedly believe in.
Okay, that makes sense. And the final truth, number 5.
Number 5 is one our minds really fight against. Every moment in the market is unique.
Unique. But don't sharp patterns repeat? Isn't history supposed to rhyme?
Well, yes, patterns emerge and probabilities exist because of recurring human behavior reflected in prices. But the specific constellation of forces, traders' beliefs, and available liquidity in this exact moment has never existed before and will never exist again.
So why is accepting this uniqueness so important?
Because our minds naturally try to associate the now moment with similar patterns from the past. This creates expectations. Oh, last time it looked like this, it shot up.
Right, leading to rigid predictions.
Exactly. But if you truly accept that this moment is unique, you can't have rigid expectations about what must happen next. You expect nothing specific. This keeps your mind open, neutral, and objective.
And if you expect nothing specific,
then there's nothing for your fear or pain avoidance mechanisms to latch onto and distort. You're just observing the now moment opportunity flow, as the book calls it, without the baggage of past wins or losses or future hopes and fears.
Okay, those 5 truths, anything can happen, don't need to know, random distribution, edges probability, every moment unique. They really paint a picture of a completely different way to approach trading. Probabilistic, not predictive.
That's the core shift.
So if the solution isn't out there, find a better indicator, but it's in here, inside our minds changing attitudes, adopting these beliefs. How do we actually do that? It sounds hard.
It can be, because we're often dealing with deeply ingrained beliefs. But the book likens it sometimes to fixing software code. You might have thousands of lines of code, but the program crashes because of one flawed line.
Uh-huh.
Fixing that one line, changing that one core faulty belief can suddenly make the whole system run smoothly. It might seem complex, but the solution, once found, can feel surprisingly simple.
Like an aha moment.
Exactly. The book talks about that aha experience where suddenly the light goes on and things that seem confusing become so simple. The market might even seem to look different, but it's really you, your perception. That's changed.
And a huge part of enabling that change, it seems, is taking total responsibility.
Absolutely critical. The market acts like a mirror. It just reflects your internal state back at you. If you feel confident, objective, it's likely because your beliefs are aligned with market realities and you're taking responsibility for executing your plan.
And if you feel fearful, angry, frustrated,
That's often because you're not taking responsibility. You're blaming the market, looking for external reasons, trying to learn more about the market instead of learning more about yourself and your reactions. This traps you in a cycle of pain.
so you have to, as the book says, stop fighting the market.
Well, which in effect means you stop fighting yourself.
Yeah. Okay, so how does the book suggest structuring this transformation? Is there a process?
Yes, it outlines a development process, starting with what's called the mechanical stage. This is like the foundation building.
Mechanical stage, what happens there?
It has a few key goals.
Mhm.
First, building self-trust. Trust that you can operate effectively in this environment with basically unlimited freedom and potential for self-sabotage. Second, learning to execute your chosen trading system flawlessly. No deviations, no second guessing based on feelings, just pure execution.
Like a robot.
Kind of, initially. It's about removing the subjective noise. Third, consciously training your mind to think in probabilities, really embedding those 5 fundamental truths we talked about.
Right.
And finally, through doing all this consistently, you create a strong, unshakable belief in your own ability to be a consistent trader.
And it's during this mechanical stage, I gather, that you really integrate the core principles of consistency. The book lists 7 of them.
That's right. These 7 principles become the embodiment of that winning, probabilistic mindset. Once they're truly part of you, part of your trading identity, they become almost effortless.
Let's quickly list them for everyone. Number 1.
Objectively identify your edges. Know what you're looking for based on data, not hope.
2.
Predefine the risk of every single trade. Know your exit point before you get in. Completely accept that predefined risk. If you can't accept the potential loss, you shouldn't take the trade. Be willing to let it go.
4.
Act on your edges without reservation or hesitation. When your signal appears, you pull the trigger.
5.
Pay yourself as the market makes money available. Take profits according to your plan. Don't get greedy.
6.
Continually monitor your susceptibility for making errors. Stay self-aware. Are fears creeping in? Are you deviating?
And finally, 7.
Understand the absolute necessity of these principles and never violate them. Discipline is key.
Okay, those 7 principles, built on the 5 truths,
Yeah.
it paints a clear picture. But how do you practice this? How do you make it stick?
The book offers a really powerful practical exercise for this mechanical stage. It suggests committing to taking, say, the next 20 trades that fit your edge without any deviation whatsoever.
20 trades in a row, sticking perfectly to the plan.
Exactly. Win, lose, or draw. If the setup appears, you take it. You manage it according to the rules. You exit according to the rules, period. It mirrors how a casino operates. The casino knows the odds are slightly in their favor over time. Do they skip a hand of blackjack because they have a bad feeling? No. They participate in every single event because that's how probabilities work out. They trust their edge over a series of events.
So this 20 trade exercise forces you to do the same.
Precisely. And it's designed to break all your internal conflicts, your fears, your desire to predict, your resistance to losses right to the surface. It forces you to confront them and consciously choose to align your actions and ultimately your beliefs with the probabilistic reality you're trying to embrace.
It really sounds like building a muscle, the muscle of trusting your system, trusting the probabilities, and trusting yourself to follow the rules, regardless of how any single trade feels or turns out.
That's a great way to put it. You're detaching from the outcome of the single coin flip and focusing entirely on the integrity of your process over many flips. You learn that being right or wrong on one trade is irrelevant. What matters is consistently playing the probabilities.
Like you said about the coin toss, you don't feel betrayed if it lands tails when you called heads. You just accept the randomness. Applying that mindset to trading, that seems like the ultimate goal here.
Indeed. Detachment from the individual outcome, commitment to the process. That's where consistency lives.
So wrapping this up, what's the big takeaway for you, whether you're deep in the trading trenches or just fascinated by markets and psychology? This dive into trading in the zone really underscores that consistent success. It's an inside job.
Absolutely. It's less about finding the holy grail system and more about waging and winning the battle within yourself.
Yeah, it demands a pretty radical shift in thinking, changing core beliefs, managing attitudes towards risk and uncertainty, moving away from fear and prediction towards probability and acceptance.
Being rigid in your rules, but flexible in your expectations.
Exactly. Rigid rules, flexible expectations. And as you think about all this, here's maybe a final provocative thought to chew on. These mental principles we've discussed, thinking differently, truly accepting risk, staying objective and carefree, being disciplined in process but open to outcomes,
Hmm.
they aren't just for traders, are they? Think about it.
Hmm.
Where else in your life do you maybe struggle because of rigid expectations, or a fear of being wrong, or maybe a reluctance to just accept that some outcomes are unknowable?
That's a great point. These principles have much broader applications.
Right. So how could embracing some of these ideas, maybe thinking more probabilistically, taking more responsibility for your reactions, how could that transform your pursuit of consistency, whatever that looks like for you, even far beyond the world of finance? Something to consider.